What if I told you that right now, at this very moment, one of the largest wealth transfers in modern history is unfolding in the silver market, and 99% of investors have absolutely no idea it's happening, while everyone's distracted by Bitcoin's latest pump, AI stock hype, or whatever financial headline is trending this week? Something extraordinary is occurring in the silver market, something that hasn't happened in decades, something that could fundamentally reshape the investment landscape for the next 10 years. I'm talking about the silver squeeze. And no, this isn't some Reddit-fueled, flash-in-the-pan movement that fizzles out in a week. This is a structural supply-demand crisis that's been building for years, and we're now at the tipping point. By the end of this video, you'll understand exactly what's happening in the silver market, why this squeeze is different from anything we've seen before, and most importantly, what you need to know before it's too late. But I need to warn you, what you're about to learn goes against everything the mainstream financial media is telling you. Let's dive in. First, let's get clear on what a squeeze actually means in financial markets, because this term gets thrown around a lot, and most people don't truly understand the mechanics. A squeeze happens when there's a massive imbalance between supply and demand. In the case of silver, we're talking about a situation where physical demand for the metal far exceeds the available supply. When this happens, prices don't just rise, they explode. But here's what makes the silver market uniquely vulnerable to squeezes, the paper market versus the physical market. See, the silver market operates on two levels. There's the physical market, actual bars, coins, and bullion you can hold in your hand. And then there's the paper market, futures contracts, ETFs, and derivatives that represent claims on silver, but aren't actually backed by physical metal on a one-to-one basis. Here's the critical point. The paper market is estimated to be anywhere from 100 to 250 times larger than the physical market. That means for every actual ounce of physical silver that exists, there are potentially 100 to 250 paper claims on that same ounce. Think about that for a second. What happens when even a small fraction of those paper claims try to convert to physical delivery? That's right, a squeeze. Now, this isn't theoretical. We've seen silver squeezes before. The Hunt brothers famously tried to corner the silver market in 1980, driving prices from $6 to $50 in just a few months. More recently, in 2011, silver rocketed from $17 to $49 as investors fled to precious metals during the debt ceiling crisis. But what's happening now is fundamentally different, and that's what most investors are missing. The silver squeeze we're witnessing today isn't driven by speculative mania or a couple of billionaire brothers trying to corner the market. It's driven by structural, irreversible changes in the global economy. Let me break down the 5 pillars of this perfect storm. Silver isn't just a precious metal, it's an industrial metal. And it's absolutely critical to the green energy transition that governments worldwide have committed trillions of dollars to. Every solar panel requires approximately 20 grams of silver. Why? Because silver is the most electrically conductive metal on Earth, and solar cells need that conductivity to function efficiently. Now, check this out. The solar industry is projected to install over 1 terawatt of new capacity by 2030. That translates to approximately 200 million ounces of silver demand per year from solar alone. That's nearly 25% of total global silver production. But it gets better. Electric vehicles require twice as much silver as traditional cars, about 25-50 grams per vehicle depending on the model. With EV adoption accelerating globally in countries like Norway, Netherlands, and even China mandating electric vehicle transitions, we're looking at an additional 90 million ounces of annual silver demand from the automotive sector by 2030. Then there's 5G infrastructure, which is being rolled out worldwide. Every 5G base station requires significantly more silver than 4G technology. We're talking about hundreds of millions of ounces of additional demand over the next decade. Add in medical applications, water purification, electronics, and other industrial uses, and you're looking at a demand tsunami that's just beginning. Here's the uncomfortable truth that the mining industry doesn't want you to know. We're running out of economically viable silver deposits. According to the Silver Institute, there hasn't been a major new silver discovery in over a decade. The average grade of silver ore has declined by approximately 30% since 2005, meaning miners have to dig up more earth to extract the same amount of silver. But here's the kicker. About 70% of silver is actually a byproduct of mining other metals, primarily copper, lead, and zinc. Silver isn't the main target. It's what you get along the way. What does this mean? It means that even if silver prices double or triple, you can't just turn on new silver production the way you might with a pure silver mine. Production is tied to the economics of those other metals. Global silver mine production peaked in 2016 at about 900 million ounces. Since then, it's been declining. In 2023, total mine production was approximately 830 million ounces. Meanwhile, total silver demand in 2023 was over 1.2 billion ounces. You don't need a PhD in economics to see the problem here. Demand exceeds supply by roughly 370 million ounces per year. That gap has to be filled from somewhere. The industry likes to point to recycling, as the solution to this supply deficit. And yes, recycling does contribute about 180 million ounces annually to supply. But here's what they are not telling you. A huge portion of silver used in industrial applications is essentially non-recoverable. When silver is used in solar panels, those panels have a 25-30 year lifespan. That silver is locked up for decades. When silver is used in medical applications, electronics, or as a biocide in water treatment, it's dispersed in such small quantities that it's economically impossible to recover. We're not talking about jewelry or silverware that can be melted down and reused. We're talking about industrial consumption that permanently removes silver from the available supply. Every year, approximately 250 million ounces of silver are consumed in ways that will never return to the market. Gone forever. Let's talk about the elephant in the room, the monetary supply explosion. Since 2020, global central banks have printed more money than in the entire previous decade combined. The M2 money supply in the United States alone increased by over 40% in just 2 years. The Federal Reserve's balance sheet exploded from $4 trillion to $9 trillion. What does this have to do with silver? Everything. Throughout human history, silver has been money. For over 4,000 years, silver has been used as a store of value and medium of exchange. It's only in the last 50 years, since Nixon closed the gold window in 1971, that we've had a purely fiat monetary system. And how's that working out? The US dollar has lost over 98% of its purchasing power since 1971. Every major fiat currency in history has eventually failed. Not some, all of them. As more people wake up to the reality of currency debasement, and trust me, with inflation eating away at savings, more people are waking up every day, they're going to look for alternatives. Gold gets all the attention as a monetary metal, but silver is the people's money. It's affordable. A middle-class family can easily buy a full ounce of gold at $2,000 plus, but they can absolutely buy silver at $25, $30 per ounce. The monetary demand for silver is just beginning to awaken. When it fully kicks in, combined with the industrial demand we've discussed, it's game over for the current pricing structure. Now we get to the smoking gun, the evidence that the squeeze has already started. COMEX, the major futures exchange where silver is traded, has seen its registered silver inventories, the silver available for delivery, drop by over 60% since early 2021. We're talking about a decline from roughly 150 million ounces to under 60 million ounces. Meanwhile, silver demand from mints worldwide is at record levels. The US Mint, Canadian Mint, Perth Mint, and others have struggled to keep up with demand. Premiums, the amount you pay above spot price for physical silver, have remained elevated at 20-40% for years now. Think about that. In a normal market, premiums are 2-5%. When premiums are consistently 10x normal levels, that's telling you something is fundamentally broken in the pricing mechanism. Eastern countries, particularly India and China, have been massive accumulators of physical silver. While Western investors have been distracted by tech stocks and crypto, the East has been quietly stacking silver by the ton. The physical metal is draining from west to east, from paper claims to physical holdings, from financial institutions to private hands. This is the squeeze in motion. Now, I need to address something that many financial commentators avoid because it's controversial: market manipulation. Look, I'm not a conspiracy theorist. I deal in facts and evidence, and the facts are clear. Major banks have been caught and fined for manipulating the silver market. In 2020, JP Morgan was fined $920 million for spoofing the precious metals markets, including silver, over an 8-year period. Traders at the bank were convicted of criminal charges. This isn't speculation, it's documented legal fact. Deutsche Bank, HSBC, UBS, and others have also settled silver manipulation lawsuits, paying out hundreds of millions in fines. The manipulation typically works like this. Large banks would place massive sell orders in the futures market with no intention of executing them, creating the illusion of selling pressure and driving down prices. Once prices dropped, they'd cancel the orders and buy at the lower price. This manipulation was possible because the paper market, futures, and derivatives is so much larger than the physical market. You could move prices significantly without ever touching actual physical metal. But here's the critical point. This manipulation required specific market conditions. It required plenty of available physical supply, low physical demand, and investor apathy. Those conditions no longer exist. When physical demand overwhelms the paper market, when people start demanding actual delivery rather than just trading contracts, the manipulation scheme falls apart. You can't deliver paper silver to a solar panel factory. You can't print physical bars to meet demand. And we're seeing evidence that the manipulative structure is breaking down. Silver volatility has increased. Price disconnects between physical and paper markets have widened. The tight control that seemed to exist for decades is slipping. The banks know this. Why do you think a JP Morgan, after being fined for manipulation, proceeded to accumulate one of the largest private silver hoards in history, estimated at over 1 billion ounces? They're not stupid. They know what's coming. So if all this is true, why isn't everyone piling into silver right now? Why is this still a contrarian position? Now, let me explain the psychology and structural factors that keep most investors in the dark until it's too late. Silver hit $49 in 2011, then entered a brutal bear market that lasted nearly a decade. Anyone who bought near that top and held saw their investment lose 60 to 70% of its value. This created an entire generation of investors who view silver as a losing proposition. They remember the pain, the frustration of holding an asset that went nowhere for years. This recency bias is powerful. It makes people overlook fundamental changes in market structure. They're fighting the last war, assuming the next decade will look like the last one. But market cycles don't repeat, they rhyme. The setup today is fundamentally different from 2011. When's the last time you saw a segment on CNBC about silver supply deficits? When did Bloomberg dedicate an hour to the solar industry's silver crisis? The mainstream financial media focuses on what generates clicks and serves their advertisers. Silver doesn't fit that narrative. It's not sexy like tech stocks or controversial like crypto. Moreover, many major financial institutions have a vested interest in suppressing precious metals enthusiasm. If people buy silver, they're not buying the latest high-fee financial product or keeping money in depreciating bank accounts. The information blackout is real, and it's effective. Most investors simply don't have this information because they're getting their news from sources that aren't covering it. Here's something fascinating about human psychology. When an asset is cheap and unloved, people think it's cheap for a reason and avoid it. When it starts moving up, they think they've missed it and stay away. There's this weird paradox where people are never comfortable buying. Too early feels risky, too late feels foolish. Silver is in that middle zone right now where it's started to move, but hasn't yet had its parabolic run. This is actually the golden zone for investors, but most people will wait until silver is at $50, $60, $70, when it's all over the news, and then FOMO in at the top. We've seen this pattern play out in every major market cycle throughout history. Let's be honest. The silver market is complex. Understanding the relationship between futures markets, physical markets, industrial demand, monetary policy, and mining economics requires work. Most investors want simple stories. This company has great earnings. This crypto will revolutionize finance. Those are easy narratives to understand. The silver thesis requires understanding multiple moving parts and how they interact. That complexity creates a barrier to entry that most retail investors never overcome. By the time the story becomes simple enough for mainstream adoption, silver prices are skyrocketing. It's already in the late stages of the move. Finally, there's normalcy bias, the tendency to believe that things will continue as they always have. Silver has been around $20 to $30 for years now. That feels normal. The idea that it could suddenly trade at $100, $150 or higher seems absurd to most people because it's so far from the current normal. But history shows us that when these structural supply-demand imbalances resolve, they don't do so gradually. They resolve explosively. The oil crisis of the 1970s, the housing bubble of 2008, the bond market volatility of 2022. These events seemed impossible until they weren't. The silver squeeze will be the same. Most people won't believe it's happening until it's already happened. While retail investors remain largely unaware, let's look at what sophisticated investors and institutions are doing. Because when you want to know where a market is heading, don't listen to what people say. Watch what they do with their money. We've seen a dramatic increase in central bank gold buying over the past few years, over 1,000 tons annually. What's lesser known is that several countries are also accumulating silver. China, Russia, and India have been particularly active. While they don't advertise their silver holdings the way they do gold, trade data shows massive imports of silver into these countries, far exceeding their industrial needs. Why would countries accumulate silver if they didn't believe it was fundamentally undervalued? Rick Rule, a legendary resource investor, has been vocal about silver being the most undervalued asset I've seen in my 50-year career. Eric Sprott, who's made billions in precious metals investing, has personally invested hundreds of millions into physical silver and silver mining companies. These aren't rookie investors. These are people who've made fortunes by identifying mispricings before the market catches on. I mentioned this earlier, but it deserves emphasis. JP Morgan, after paying nearly $1 billion in fines for silver manipulation, went on to accumulate the largest private silver position in modern history. Think about the audacity of that. They got caught manipulating silver prices down, paid the fine, and then bought up silver at those suppressed prices. If that doesn't tell you something about where they think prices are heading, I don't know what would. Insider buying at silver mining companies has reached multi-year highs. When executives and board members, people with intimate knowledge of their businesses, are buying shares with their own money, that's a powerful signal. These are the people who know what their costs are, what their reserves look like, and where they think silver prices are heading. And they're buying. While some ETF outflows have occurred as people convert paper to physical, certain funds like PSLV, Sprott Physical Silver Trust, have seen massive inflows. The key difference? PSLV actually holds allocated, segregated physical silver. Each share represents actual metal you could theoretically take delivery of. The fact that investors are increasingly preferring physically backed vehicles over paper proxies tells you something about the market's maturity and awareness. So we've established that the structural conditions for a squeeze are in place, but what could be the catalyst that takes this from a slow building pressure to an explosive event? Let me outline the potential trigger events. If a significant number of futures contract holders demand physical delivery and COMEX can't meet that D end, it would shatter confidence in the paper market overnight. We've already seen stress in the system. There have been months where deliveries approached available registered inventory. We're getting closer to a breaking point. A default wouldn't mean COMEX shuts down. More likely, they'd settle in cash at prices far above spot. But it would prove that paper and physical are not equivalent, potentially triggering a mass exodus from paper to physical. Imagine this scenario. A major solar panel manufacturer announces they can't secure enough silver to meet production targets. They're forced to either shut down lines or bid up silver prices dramatically to secure supply. This would put silver on the front page of every business publication. Suddenly, the industrial demand story goes from niche knowledge to mainstream awareness. The scramble for supply would be unlike anything we've seen in the silver market. If we see a currency crisis, whether it's a dollar crisis, a euro crisis, or a broader loss of confidence in fiat currencies, silver, along with gold, would be an immediate beneficiary. Given the levels of debt globally, the ongoing money printing, and geopolitical tensions, a currency crisis is not a matter of if, but when. When it happens, people won't carefully research the best precious metals allocation. They'll panic buy whatever they can get their hands on, and silver, being more affordable than gold, could see even more dramatic inflows. If one of the world's largest silver mines, or several mid-tier mines, were forced to close due to accidents, political issues, or economics, it could remove tens of millions of ounces from annual supply. In a market already running a deficit, the loss of major production would be catastrophic for the supply side. We've already seen this happen in other commodities. A single mine closure in palladium or lithium has sent prices soaring. Silver is no different. Currently, institutional allocation to precious metals is at historic lows, less than 1% of portfolios on average. If institutions were to shift even 2 to 3% of their portfolios into precious metals, we're talking about hundreds of billions of dollars of buying pressure. The trigger could be a change in regulations, a shift in investment mandates, or simply a reassessment of risk in traditional assets. When institutions move, they move size. And the silver market is small enough that institutional buying could overwhelm available supply almost immediately. I am not a financial advisor. Nothing in this video constitutes financial advice. Consult with a qualified professional before making any investment decisions. This is for educational and entertainment purposes only. With that said, let me share some general thoughts on how investors are approaching this opportunity. The foundation of any silver position should be physical metal, coins, bars, rounds, actual silver you can hold. Why? Because in a squeeze scenario, physical silver is what has true scarcity. Paper promises can be printed infinitely, but physical bars cannot. The drawback is storage and security, and you'll pay premiums above spot price. But in a true squeeze, those premiums could be the least of your concerns. Silver mining stocks offer leverage to the silver price. When silver goes up $1, a miner's profit might increase by a much larger percentage because their costs are relatively fixed. In the 2011 silver run, some mining stocks went up 300–500%, while silver itself doubled. The risk is that mining stocks are still stocks. They're subject to market volatility, management risk, and operational issues. Major producers offer more stability but less leverage. Junior explorers offer massive leverage but high risk. Many investors find a middle ground with developers, companies that have found deposits and are moving toward production. They offer significant upside with somewhat less risk than pure explorers. Royalty and streaming companies provide upfront capital to miners in exchange for the right to purchase silver at a significant discount in the future. This business model offers exposure to silver prices with less operational risk than mining companies. Companies like Wheaton Precious Metals operate on this model and have substantially outperformed traditional miners over long time periods. Here's the reality. Silver is volatile. It can drop 30% in a matter of weeks, then double in months. Most wealth advisors who are bullish on silver suggest a 5,215% portfolio allocation, with the percentage depending on your risk tolerance, investment timeline, and conviction. It's not about going all in on silver. It's about having meaningful exposure to a potential generational wealth building opportunity while maintaining a diversified portfolio. Rather than trying to time the perfect entry, many successful precious metals investors use dollar cost averaging, buying a fixed dollar amount on a regular schedule. This approach removes emotion from the equation and ensures you accumulate when prices are low while still participating when prices rise. Given silver's volatility, DCA can be particularly effective compared to lump sum investing. Now, in the interest of balance, let me present the strongest arguments against the silver squeeze thesis. You should understand both sides. Critics point out that silver bulls have been predicting a squeeze for decades, and it hasn't happened. Fair point. Timing is difficult, and many previous predictions were premature. The counter-argument is that the supply-demand fundamentals have genuinely changed in the last few years with the green energy transition. The old predictions were based on monetary factors alone. Today's thesis combines monetary and industrial demand in unprecedented ways. Some argue that high silver prices will incentivize the development of alternatives, reducing industrial demand. This is theoretically possible, but practically difficult. Silver has unique properties that are hard to replicate. Moreover, developing and commercializing alternatives takes years, even decades. By the time alternatives are viable, the squeeze may have already played out. The argument here is that governments and central banks have a vested interest in keeping precious metals prices low to maintain confidence in fiat currencies, and have the tools to do so. This was more viable when the market was primarily financial. But when you have physical industrial demand that must be met, solar panels that must be built, financial engineering has limits. You can manipulate paper prices, but you can't print physical silver to put in a solar panel. If we enter a severe recession, industrial demand for silver could decline, particularly from electronics and manufacturing. However, recession scenarios typically include monetary stimulus, which benefits silver as a monetary metal. Additionally, green energy initiatives are typically government mandated and funded, making them more resilient to economic cycles. The 2008 financial crisis actually saw silver bottom and then begin a multi-year bull run. Let's zoom out for a moment. The silver squeeze isn't happening in isolation. It's part of a broader restructuring of the global economy and financial system. Governments worldwide have committed to net zero emissions targets. The EU, US, China, and over 100 other countries have set dates for carbon neutrality. This isn't a trend that's going to reverse. The political, social, and now economic momentum is too strong. Silver is indispensable to this transition. There is no net zero without solar. There is no efficient solar without silver. The current fiat monetary system is showing signs of strain. Negative real interest rates, perpetual quantitative easing, currency debasement, these are symptoms of a system in crisis. Throughout history, when monetary systems fail, people return to tangible stores of value. Silver and gold have played this role for thousands of years. We may be witnessing the early stages of a monetary reset, where hard assets regain importance relative to paper promises. The world is fragmenting. Supply chains are being re-regionalized. Countries are prioritizing resource security. In this environment, countries want to ensure they have domestic access to critical materials, including silver. This deglobalization trend supports both higher commodity prices generally and specific supply pressures in materials like silver. For individual investors, the challenge of the coming decade is wealth preservation. With inflation running hot, real yields negative, stock valuations at historic highs, and bond yields failing to keep pace with inflation, where do you preserve purchasing power? Silver offers a potential solution, a hard asset with both industrial utility and monetary properties, currently undervalued relative to historical norms and future demand. The question everyone wants answered, when will this happen? The honest answer is, I don't know, and anyone who claims to know exactly is lying to you. What we can do is look at historical precedents and current trajectory. In this scenario, silver grinds higher over the next 2 to 3 years as industrial demand consistently exceeds supply, inventories continue to drain, and awareness gradually builds. Price reaches $40, $50 by 2026, $60, $80 by 2027 and 2028. This would be the rational outcome, where markets gradually price in the new fundamentals. In this scenario, catalyst event triggers a rapid repricing. Silver goes from $25 to $50 in a matter of months, potentially pushing toward $100 as FOMO kicks in and a genuine shortage develops. This would mirror the 2011 spike, but potentially with more staying power due to the industrial demand component. In this most bullish scenario, we're entering a decade-long commodity supercycle, similar to the 2000-2011 period. Silver moves from $25 to $50 to $100 to $150 plus over a 5-8 year period, with corrections along the way but a sustained upward trajectory. This scenario requires the convergence of multiple factors: sustained inflation, currency crisis, continued industrial demand growth, and supply constraints. Based on the fundamentals, some version of the spike or supercycle scenario seems more probable than sideways grinding or decline. The setup is too compelling. The supply-demand imbalance is too severe. The trends are too entrenched. The variable is timing and magnitude, but the direction seems clear. So, given everything we've discussed, what should you do right now? Don't just take my word for it. Research this yourself. Read the Silver Institute's annual reports. Study supply-demand data. Understand the mining industry. Look at industrial applications. The more you understand the fundamentals, the more conviction you'll have, and the better you'll be able to weather volatility. Before investing in anything, make sure your financial house is in order. Emergency fund? Check. High interest debt paid off? Check. Clear investment goals and timeline? Check. Silver is a long-term strategic position, not a get-rich-quick scheme. You don't need to deploy all your capital at once. Start with a small position, maybe buy a few ounces of physical silver or a small position in a mining ETF. Get comfortable with the asset class, understand its volatility, and build from there. Don't put all your silver allocation into one vehicle. Consider a mix, some physical, some miners, maybe some royalty companies. This diversification within your silver position gives you exposure to the metal's upside while managing company-specific risks. The biggest mistake investors make with silver is getting shaken out by volatility. Silver will have 20-30% corrections, even in a bull market. If you're not prepared for that volatility, you'll sell at the worst possible time. Set a 3 to 5 year time horizon minimum. View short-term volatility as opportunity, not danger. Check in on your thesis quarterly, not daily. Follow major developments in supply, demand, and market structure. But don't let short-term price movements drive your decision-making. The fundamentals will play out over months and years, not days and weeks. So let's bring this all together. The silver squeeze has already started. It's not speculation or hopium. It's visible in the data if you know where to look. COMEX inventory is down 60%. Record mint demand. Persistent high premiums. Industrial demand projecting to exceed total mine supply. Supply deficits for multiple consecutive years. These are facts, not forecasts. Most investors won't realize what's happening until silver is at $50, $75, or $100 per ounce. At that point, the mainstream media will finally cover it, the financial talking heads will declare it obvious, and retail investors will FOMO in near the top. But you don't have to be most investors. You have the information now. You understand the supply-demand dynamics. You see the trends that are driving this once-in-a-generation opportunity. The question is, what will you do with this information? Will you wait for more confirmation, for the move to be proven, for everyone else to validate your thesis? By then, the easy money will have been made. Or will you have the courage to act on conviction, to position yourself ahead of the crowd, to take advantage of the fact that markets reward those who see things before they become obvious? Think about every major wealth-building opportunity in history. The investors who profited most weren't the ones who jumped in when it was safe and obvious. They were the ones who saw the opportunity when it was still contrarian, when the fundamentals made sense but the crowd hadn't caught on yet. Real estate in 2009, Bitcoin in 2013, tech stocks in 1995, silver in 2024. If this video provided value, helped you understand something important, or gave you a perspective you hadn't considered, do me a favor. Hit that like button, subscribe to the channel, and share this with someone who needs to see it. The algorithm won't promote content like this because it goes against mainstream narratives. The only way this information spreads is if viewers like you share it. Drop a comment below telling me, are you positioning for the silver squeeze? Or do you think this thesis is wrong? I read every comment, and I'm genuinely interested in your perspective. And if you want to go deeper on precious metals investing, I've got a whole playlist covering gold, platinum, mining stocks, and the broader commodity supercycle. Link in the description. I also send out a weekly newsletter with the latest developments in precious metals markets and opportunities I'm watching. That's completely free. Link is in the description if you want to stay updated. The silver squeeze isn't coming, it's here. The question isn't whether it will happen, but whether you'll realize it in time to benefit. Most investors will realize too late. Don't be most investors. I'll see you in the next video.